I always say tariffs is the most beautiful word to me in the dictionary.
It all started with a shockwave with Donald Trump's return to the presidency, and a tsunami of tariffs was unleashed on the global economy. These weren't just minor adjustments, they were seismic, with rates exceeding 100% on some goods from China and base tariffs of 30% or more, threatening imports from Mexico, Canada, the European Union, and even close allies like Japan. The immediate reaction was textbook panic. Markets plunged, industries cried foul, and a chorus of pundits predicted a catastrophic global recession, arguing that this was reckless posturing destined to backfire on the United States. But as the initial dust begins to settle, a radical and frankly unsettling thesis is emerging from behind the noise. What if the chaos wasn't the plan going wrong? What if the chaos is the plan? First, let's be clear. This is not your grandfather's old-school protectionism. The intellectual engine behind this strategy is a new economic team led by figures like Treasury Secretary Scott Bessent, a hedge fund veteran accustomed to high-risk, high-reward plays, and top White House economist Stephen Miran. For them, tariffs are not simply defensive walls to shield American jobs. They are offensive weapons, high-pressure negotiating tools designed to create a crisis so acute that it forces reluctant partners to concede. Their core diagnosis is that for decades, the U.S. adhered to a neoliberal free trade orthodoxy that systematically hollowed out its industrial base, shipping factories, jobs, and technological know-how overseas. They argue this consensus, while enriching multinational corporations and the financial class, made America strategically vulnerable and economically weaker. Their goal is to reverse this decline, not by retreating from the world in isolation, but by re-engaging with it on entirely new, far more aggressive terms. So when you break it all down, the strategy really unfolds in three distinct acts. It kicks off with what you could call an economic shock and awe campaign. The idea is to slam the global system with tariffs so high and so sudden that it sparks a genuine crisis, making the old way of doing business seem completely untenable. From this point of view, the panic in the markets and the chaos in the supply chains aren't just unfortunate side effects, they're the whole point. It's about creating immense leverage out of thin air by demonstrating a willingness to both absorb and inflict serious economic pain. And that leverage is the key that unlocks the next phase. This is where the playbook pivots from pure disruption to hard-nosed negotiation. With the world on edge, the U.S. can sidestep big, multilateral groups like the WTO and pull countries into one-on-one talks. In those closed-door meetings, access to America's massive consumer market becomes the ultimate weapon. Tariffs are no longer just a wall. They're the primary bargaining chip used to demand sweeping concessions on everything from trade deficits to security cooperation. But even winning these individual battles isn't the final objective. You have to see them as the building blocks for something much bigger. The true endgame here is to construct an entirely new global agreement, one designed to replace the system we've all known since World War II. This new order wouldn't pretend to be about equality. It would be openly hierarchical. In this world, access to the coveted U.S. market would no longer be a given. It would be a privilege, one explicitly tied to how well a nation aligns with America's geopolitical and security interests. The administration insists this strategy isn't just chaos for chaos's sake. It's rooted in a set of controversial and, to many mainstream economists, dangerous ideas. First is the optimal tariff argument. In simple terms, this economic theory posits that a country with a large enough economy to influence global prices, like the United States, can impose a tariff and force foreign exporters to absorb most of the cost. When the U.S. slaps a 25% tariff on a product, the foreign company, desperate to remain competitive in the American market, might be forced to lower its pre-tariff price. Treasury Secretary Bessent has argued that this effect, combined with a strengthening U.S. dollar that makes imports cheaper, means the primary burden of the tariffs falls on foreign nations, not American consumers. However, this is a classic beggar-thy-neighbor strategy. It functions by making your trading partner poorer. The most significant risk is retaliation. If every country responds by imposing its own optimal tariffs, global trade could seize up in a tit-for-tat protectionist war, damaging the entire global economy. One analysis by leading economists projected that in a scenario of full global retaliation, U.S. economic welfare could fall by over 5%, a substantial hit to national prosperity. The second core idea is championed by economist Stephen Miran, who revives the Triffin Dilemma. This long-standing economic paradox states that because the US dollar serves as the world's primary reserve currency, America is structurally forced to run persistent trade deficits. For other countries to hold dollars for international trade and reserves, the US must supply those dollars to the world, which it primarily does by buying more goods and services than it sells. Moran argues that this has kept the dollar artificially strong for decades, making American exports expensive and imports cheap, thereby subsidizing the hollowing out of US manufacturing. From this viewpoint, the trade deficit is not a sign of profligacy, but a structural burden the US has carried for the benefit of the global system. Tariffs, therefore, are the tool to rebalance this system and force other nations that benefit from the dollar's reserve status to share more of the adjustment cost. The endgame of this doctrine is the most radical part: to use the economic pressure from tariffs, which paradoxically strengthen the dollar in the short term as a safe haven asset, to force major economies into a new currency pact, dubbed a potential Mar-a-Lago Accord. The goal would be a coordinated effort to weaken the dollar, making American manufacturing globally competitive again. It's an incredibly high-stakes bet. If it backfires, it could trigger a catastrophic loss of confidence in US debt and the dollar itself. Is this grand experiment actually working for the American economy? The answer is a deeply complicated and messy mix of gains and losses, creating what looks like a two-track economy. On one hand, there are undeniable signs of a reshoring boom. Already spooked by the fragile supply chains exposed during the pandemic, companies are now accelerating plans to move production back to the US to avoid the tariff cliff. High-tech giant Nvidia announced plans to manufacture AI supercomputers domestically, and even European luxury brands like LVMH are reportedly exploring expanding their manufacturing footprint in America. But this tells only half the story. For every potential winner in a protected industry, there appears to be a loser downstream. The tariffs function as a direct tax on the parts, materials, and machinery that countless American businesses rely on. The problem is a classic economic squeeze. Upstream producers like steel and aluminum companies are shielded by tariffs and can raise their prices. However, the downstream manufacturers who must buy that steel to make their products are now slammed with higher input costs, making them less competitive. Take the case of Jordan Manufacturing Company in Michigan. The firm doesn't even use imported steel, yet its costs have surged by 5% to 10%. Why? The 50% tariff on foreign steel gave domestic US steel producers the market power to hike their prices for everyone. Or consider Montana Knife Company, a small business that ordered a specialized blade grinding machine from Germany for a simple reason. No American company manufactures one. The 15% tariff levied on EU goods added a staggering $77,250 to the machine's cost, capital that the owner says could have been used to hire a new employee. On the macroeconomic level, the numbers are sobering. The nonpartisan Congressional Budget Office projects that the tariffs will shrink the U.S. economy in the long run by about 0.6%, and could cost the average American family up to $2,400 per year in higher prices. The Tax Foundation estimates a potential long-run loss of nearly 788,000 full-time equivalent jobs. While the administration points to the tariffs as a deficit reduction tool, projecting they could collect an estimated $2.5 trillion in new revenue over a decade, the CBO counters that this is a highly inefficient method, as it shrinks the overall economic pie from which the revenue is drawn. The global response to this tariff shock has been a volatile mix of forced negotiations, strategic retaliation, and deepening anxiety. The administration's diplomacy by force has, on the surface, yielded results. Staring down the barrel of a 30% tariff cliff, the European Union agreed to a deal where it now faces a 15% base tariff on most goods. Japan, under similar pressure, accepted a 15% tariff and, in a major concession, pledged to establish a $550 billion fund to invest in U.S. infrastructure and industrial projects. The administration hails these as victories. Critics, however, argue that what was won was a new global standard of higher protectionism, effectively dismantling the low-tariff world the U.S. itself had championed for over 70 years. But make no mistake, retaliation is happening, and it's growing more sophisticated. The administration appears to operate on the belief that the U.S. can win any trade war because its economy is less dependent on exports than others. Yet analysis of the 2018 trade conflict shows that countries like China did not retaliate randomly. They surgically targeted their tariffs at agricultural and industrial products, from politically sensitive, heavily Republican districts, aiming to maximize political pain for the administration's supporters. The main event, of course, remains the standoff with China. After threats of tariffs as high as 145%, the situation has settled into an uneasy truce, with the U.S. maintaining a 30% tariff on most Chinese imports, and China imposing a 10% retaliatory tariff. But the key takeaway is China's remarkable resilience. By aggressively seeking new markets for its goods in the global South and Asia, China is on track to run a global trade surplus of nearly $1 trillion in 2024. This standoff demonstrates the inherent limits of using economic force against a global superpower with its own vast domestic market and extensive global reach. But the real stakes here go way beyond the economy. This is a full frontal assault on the entire global order built since World War II, replacing its cooperative principles with a confrontational winner-take-all strategy. And the single greatest risk is to the US dollar itself. For decades, America's exorbitant privilege meant everyone ran to the dollar in a crisis. But when the April 2025 tariffs hit, a Stanford study found the exact opposite happened. For the first time, foreign investors started dumping US assets, weakening the dollar and raising borrowing costs. By weaponizing America's financial power, the administration is practically daring the world to find an alternative. At the same time, it's turning alliances into transactional bargains, fracturing global relationships into competing blocs. You see, this isn't random chaos. It's a breathtakingly audacious gamble to tear down the old system and build a new one with America explicitly on top. The path to pulling it off is a tightrope walk over a canyon, requiring a diplomatic miracle and an American public willing to foot the bill. The path to failure, however, is a 4-lane highway leading to a global recession, a dollar collapse, and political revolt at home. The ultimate question is everything. Is this a masterstroke that will rewrite the rules in America's favor for the 21st century? Or a catastrophic blunder that shatters global stability for generations? Let us know your thoughts, smash that like, and subscribe for more.